This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. Once again, we are joined by Sean O'Toole with PropertyRadar. So let's get into some real estate discussion. Your client base obviously has grown a lot since trustee sale buyers.
Yeah.
So what's the mood of some of these participants about now?
Yeah, I mean, it's tough for a lot of folks, right? I mean, sales volumes are way down. We had an unprecedented number of people lock in extremely low mortgage rates, in the 2s and the 3s.
Yeah.
They may really want to move, but to move right now and go into the 6s or 7s is a pretty big hit on their affordability, on their, what they can afford.
That's right. They would be moving down for sure, right?
Moving down for sure. And so you don't have very many people who want to sell. So we've got this crazy situation where we have low inventories and low sales. And not low sales, solely because of low inventories, but also low sales because the buyers, even the stuff that is on the market, buyers really can't afford. And so it's, but there's no reason with low inventory, right? Prices aren't going to come down. So it's kind of a stalled market. It's not completely stalled. There's still going to, always be stuff, selling, but the volumes are way down. And so you have to be on your game. If you want to have the same number of sales as you had the last few years, you've got to go take those sales from your competitors. You got to put some people out of business.
So you just brought up it's funny. I look at this unemployment rate at record lows, and then I think of our industry, and I think, well, that's nonsense. We're at 50% unemployment. We literally are 50% of the revenue.
Yeah.
For an entire industry. You can put it any way you want. 50% of the people are making all of the money, and the other people are but they're still gainfully employed apparently, but not making a dime.
Well, the 80-20 rule is the Pareto principle. And right. I always joke that real estate is the one industry that breaks the Pareto principle because 10% of the people make 90% of the money.
That's right. And so those guys are making,
their revenue's down too.
That's right.
Yeah.
The industry's making half, but we still don't, people that are making nothing as a realtor still are gainfully employed, apparently.
I'm going to take exception though, that they're making half, right? Because if we roll prices back to say 2018, 2019 pre-pandemic, when they were 30-40% lower in some places, right?
Right.
You now have a much lower volume, but you still have the much higher prices. The revenue historically is not that down.
Oh,
it's down a lot versus 21, 22, but it's not down that much versus 2018, 2019.
Okay. So I was referring to last year. So the
last year it's a bloodbath for sure. But the last year, it's like our governments do. Every time we get a bubble, they think that bubble is going to continue forever and they keep spending it. And, hopefully these folks learned from 2008. They had a couple of great years, 21, 22, and they put some money aside and didn't go spend it all on cars and houses because those were, from a commission standpoint, those were bubble years. They were not sustainable, though there was no reasonable prediction that kind of revenue would be generated out of real estate on an ongoing basis. It's never been done before, and it's not likely to be done again, kind of like 2008 foreclosures.
Yeah. Well, that's interesting because that pandemic happened about 3 months after I had done a report. And if you remember the end of 2019, you already had, there's some information that one of the reports I buy, that 25% of the inventory that they charted by appraising the same property for the last 30 years, every 6 months, and thousands of them, they already had 25% losing value at the end of 2019. And so all of a sudden it's off to the races. So that's what's really interesting. We went from, basically closing in on 600 grand in 2019 as a median, and we touched 900 for a couple of months. And now we're at 735. And that's still probably, well, it is too aggressive because it's still got a affordability number that's basically at the bottom 17%.
And based on incomes, and current interest rates, that number should probably be 400.
Yeah, that's exactly what it should be. It's 435. We have a thing called a moodometer where we basically say, yeah, so that's right. So, and what's saving it is there's no urgent group of sellers that are dominating the market. That would have to come from foreclosures, which I don't think this time is going to occur, or the unemployed, right? But even then, they probably have a positive cash flow rental, as odd as that is.
Yep.
So it's a really weird scenario where the math seems like, okay, it's going to take a huge hit. And then you have, I'm working on a new report, so I'm always thinking about, I don't have that chart. So the ratio of where all the volume comes from. So if you take a look at all the years, there's a progression. When things do well, new construction gets up to 21% of the marketplace, 79% existing listings or existing homes. And it might go down to, say, 12% in 2009 where you can't afford to build anything. Right. So the normal ratio is, say, 17%. So 83% of the inventory normally is coming from existing houses. And what you said, okay, well, wait a minute, what's my motivation for selling my existing house with a 3% mortgage, especially after there was a lot of things going on and during the pandemic, like here's a bunch of money. And all of a sudden you go, I've always wanted an office or a fourth bedroom or whatever. And you did that.
Yeah.
And now you kind of, and as a matter of fact, what they call about like pulling the volume forward. That's what happened, like the boat purchases and all that. If you were a boat dealer, you were like the happiest guy in the world for a year and a half.
Bicycle, yeah, whatever, bicycle shops. Everybody was crushing it.
Yeah, every
if they could get inventory.
Every toy that could be owned. But now, so you're going to have sales volume be about half, but the price hit is really going to be relying on an urgent group of sellers.
A lot of people talk about, the inflation and it being due to putting too much stimulus out there, right? And this is a form of stimulus, but I think something I rarely hear in that calculation is all those folks, something like half of people with mortgages refinanced in 2021, 22. And they went from, say, 4.5% to 3, 2 3/4, something like that. You're adding $500, $1,000 a month,
right, net
of disposable income.
Yeah.
Right.
Yeah.
And so at the same time, we're putting stimulus out there because we're working. We were failing to recognize that these really low mortgage rates were a huge stimulus at the same time. I still hear no economist, nobody talk about this other stimulus from lowering of mortgage rates and how much that increased free cash flow, way more than the stimulus dollars. And I actually think that is a much more significant source of the inflationary pressure that we got than the stimulus that the Fed and
I have to admit, I never even thought of it, but you're right. Every household got an extra 500 plus to spend permanently.
Yeah, it's huge permanently, right?
Yeah.
And so everybody, and then all these people are like, oh, we're going to inflation, we're going to have a recession, it's going to be terrible. And I'm like, have you looked at how much and then, wages are going up at the same time that their expenses just went, their biggest expense, their house expense went way down, right? That two things, nobody's talking about it. Like, oh my God, right? And then look at the amount of equity. At the peak, it was $29 trillion of equity.
Yeah.
That's something like 4 times where we were at the bottom in 2008, more than double the last peak. I think it was $12 trillion of equity at the last peak, 29 trillion. It's back down a little now because prices have come back down, but what is it, 25 now? It's still, when people start, and I guarantee you in America, Americans love debt, right? And they are going to tap that $25 trillion somehow before they stop going out to eat, before they stop going on vacation, right?
Yeah.
So all these folks worried about a recession, pull back. It's possible. It's possible. You know, we do something dumb and we drive the thing off the cliff. But boy, there's a pretty big, you know, stimulus there just in the 65% of the folks that own real estate that nobody's talking about.
Yeah,
Well,
no one has, just a second, Joey. No one has an adjustable mortgage on their house. So, you know, not from the last few years anyway. So that's really a permanent gain on their budget. So
30 years at 2.5% to 3.5% when they were at 4.5% to 5.5%. I mean, it's just a tremendous amount of disposable income.
yeah,
Well, the opposite end of that is it's killed two things. The older generation downsizing because they can't. And then the people who got in, let's say in the last 5-10 years, their second and third homes aren't happening either.
Yeah. It's a lot. I mean, there's a lot of moving pieces. It's the reason economics is an art, not a science. There are so many pieces. Every time somebody says, I know what's going to happen in the future, like, you know, because of this and this and this. It's like, those are 3 variables out of a million variables. You don't know shit.
that's what's scary. You know, you and I had an email exchange in 2017, and I was going to put the cover. I was going to put what I was going to put on the cover anyway. But you're about the most sane person I know, and really connected to the same kind of data. I said I'm about to put 2% mortgage in our future on a cover, and you text me back pretty quickly and said I think you're right.
Yeah,
so,
totally.
So
I still think, you know, it's because we're not learning any lessons, right? If you look at the powers that be, you know, both on the fiscal side, you know, Congress, presidents, et cetera, both parties, and on the monetary side, right? We only know one playbook. I think that if we do drive things off the cliff, we could see mortgage rates in the 1s next time.
The cover, the title that we just created is what's next? Either a lost decade or a 1% mortgage rate.
Yeah.
But you're right. That's the pattern that we have followed. Now, Joey just found a report for me that I'll be reading today, and it has to do with Japan's lost decade.
Yeah.
So I'm going to.
And they have 1% mortgage rates.
I'm surprised. I don't even know if it was 1%. It's crazy, Bo. And I think it might be less. So, but they must have had a choice at that point, right? All of that stuff was happening. Well, do you just get the reset button and you go through all this stuff that
and it's lost 3 decades now for them?
That's right. Yeah, they haven't still gone back to their real estate values, and that happened in the late 80s, right? When that started to crack.
Yep, for sure.
Wow.
So
well, that's one of the things that in the history you can look at and go, okay, that decision that they made to go to an interest rate at that point, they didn't make the other decision. And that's, I'm working on that right now, thinking, okay, what is the price to be paid if we say we're not doing that? We're going to normalize interest rates for the people in our future that have money, they'll have yield and all that stuff. Okay, well, you're going to attach that to what, $33 trillion worth of debt? That's the interest alone on that is $1.5 trillion. So how does that play out?
Right. You'd have to have some sort of debt jubilee and not make good on the debt, which we've never done, right? As a country, we've always paid our debts. It's actually a current topic right now, with the debt limit renegotiation happening. At the end of the day, we have these problems, the 2%, because we're the world's reserve currency, right? And what we should be doing as a country is doing everything we can to come together to protect that, because it gives us such huge advantages. If you want to keep America great, right, you protect being the world's reserve currency at all costs.
Right.
Which means you pay your debts, right? Which means you probably get a little smarter about, deficit spending. And for those that want to point to the Democrats, if you look at the actual data, and I don't like either party, so let me just put that right out there. But if you look at the actual data, our debts go up faster under Republican regimes than they do under Democrat regimes. They just spend it differently.
At the end of each of the events we've had, I Survive Real Estate, I say the same thing. I would love for every Democrat and Republican to act like an American first, you know what? I was so naive when I started saying that. I actually thought that would occur. And it's sad.
It's what has to happen, though, because if, Ray Dalio is a good read. And, one of the things he looked at the fall of empires, right?
Right. Yeah.
Going way back. And, one of the key signs of fall of empire is internal discord, right? It is, if you want to seal our future in, because if we lose world reserve currency, then this playbook that we've seen where it got us to 2% rates and where you and I think it could get us to 1% rates happens if we're the world's reserve currency and we continue down these same playbooks and we get that benefit. If we lose that, if we have a fall of empire, then we don't get that benefit anymore. And rates are not going to be out of our control, right? So this is where things then get really bad for the United States for an extended period of time. And it's not a gift I want to leave my kids. No. And the number one thing we need to do to stop that is to come together as a country and stop being divisive. And we want to blame politicians for this, but it's us, right? We want to blame the other. And if we each individually understand that both these things are bad, we need to find more ground in the middle. This country's great because we found middle ground, because of compromise. Right? Our Constitution is a product of compromise. And until we start electing officials that are compromise minded, that want to find middle ground, that want to find solutions, right? We don't deserve to be great again, and we won't be great again. And neither side can make us great again, because it's compromise in middle that will keep us great.
I don't know how it'll happen, but I hope at some point we have term limits, because I think that would end up with a very different group of people wanting to take their 8-year term as opposed to spend 40 years in that seat,
Yeah. Well, I think most of those folks that, are 40 years in that seat, 40 years ago, they were about compromise and the rest. And they've been radicalized, and they haven't been radicalized by themselves. They've been radicalized by us, the public, going clickbaity and going one direction or the other and buying into tribalism.
Right.
And
yeah.
So I actually don't blame the politicians. It's us. We're the ones causing this.
Well, we the people can say, okay, we're only going to let the next group in for 8 years. And I think we'd have a whole different attitude amongst them, So
let's only vote for folks that are, want to believe in compromise, find solutions, work on stuff, make improvements, and then not jump around on sound bites on social media.
Do you, so we've talked a little bit about residential real estate. Do you see any major problems coming up for like the office stuff?
Yeah, so that one's, the big difference between residential and commercial is most of the commercial stuff's, 5 years, right? So it might be a 30-year, 20-year amortization, but, it gets reset every 5 years. And so you start looking at that and, the initial take is going to be, wow, it's going to be a bloodbath, because you bought this thing at a 4% rate and it's going to go to an 8% rate because the rates are higher on the
Right.
commercial side, right? And
Sure.
suddenly this thing that looked okay is very underwater, and then add some vacancy to that or some other turmoil in the economy, right? And you get a lot of commercial that looks really pretty darn ugly right now.
Well, the commercial building that I bought in Riverside, when it was built, I'm gonna guess at the year, probably toward the peak of 2006 or something, was $1 million. Somebody bought it for $1 million. I bought it for $319 when it became an REO. I just sold it last year for $1 million. So it just got back to its stage. Now, what's interesting about an industry of real estate, when you're doing half of the volume, and the mortgage industry, if you have a lease to renew, you're not going to take all the space.
Right.
There's no way.
So this is where I think the commercial, and there's more to this, but I'm going to keep it simple for right now, right? So we just saw Silicon Valley Bank fail, and
Right.
they fail because they took people's deposits, they made long-term investments in mortgage-backed securities, in treasuries, and other things at a very low
Yeah.
rate. And then people stopped funding venture companies, right? And the venture companies were using their cash, and they needed those deposits back, and they were in these long-dated securities. And Silicon Valley Bank went, wait a second, we ran out of short-dated stuff to sell. We got to go sell the long-dated stuff. And to do that with higher rates, we've got to take a loss today.
Right.
If they've been able to hold those long-dated securities till the end, there's no loss, right? But they have to sell them today to give people their cash. So they take a loss, causes a run on the bank, very bad, right? So this has a lot to do with the commercial side too, right? So we're going to have these loans come up for, renewal, and the bank's going to say, well, hey, you got to go refinance, right? Maybe we don't want that loan anymore. You got to go refinance somewhere else, or we're willing to refinance, but your rate's now double, right? Mm-hmm. And if banks do that in mass, we're going to see, and force the sale of those assets and the rest, we're going to see carnage.
Right. Absolutely.
I think if they paid any attention in 2008, they've learned the lesson to go, you know what? We're a healthy bank today getting that 4% rate.
Right.
Be a healthy bank tomorrow if we keep taking that payment. That commercial mortgage, the person who owns that commercial mortgage is making that payment today. They can make it tomorrow.
Mm-hmm.
All you have to do is let cooler heads prevail and go, you know what? We can't adjust these rates right now. And you have no crisis.
I agree with you.
And that's what should have happened in 2008 with housing as well. We could have just completely avoided the crisis by saying, you know what, make the payment you're going to make, and we're going to clean this up over time.
Yeah.
Instead of forcing all this inventory on the market and crashing the market. Now, where this gets complicated, and I'm not enough of an expert here, but this would be a good place for you, certainly, as you're talking to your experts, is back in 2008, the banks didn't hold this debt, right? They went and packaged it up and put it in tranches of all these securities. And so then their hands are kind of tied. And not only that, but these banks are now servicing that debt, and they get a higher servicing fee when it's in default than when it's getting paid.
So
right?
there was some motivation for that.
Yeah, so no motivation to try to work it all out with all these different parties and all these different tranches and all these instruments where you can't even, these instruments, there's not even a way to like talk to the members to have it vote on something different. It's just a contract. You have to meet the contract or you don't, right? So I don't know what that all looks like on the commercial mortgage-backed security side, the CMBS world, and whether or not, some of those things are going to force some defaults through versus banks just going, you know what, make the payment you can make. So that's going to be interesting to watch how it plays out. I haven't completely figured it out yet, but I hope we find the right solution there. Keep these properties. Well, part of me does hope, right? Like obviously, if you have a bunch of commercial foreclosures and all the rest, I'm going to make money. but I don't think it's the right thing for the economy. So it'd be a great thing for me personally in the business I'm in to have the whole thing go to shit. And I think a lot of the venture capitalists that told their companies to pull their money out of SVB did it because they wanted to see the thing go to shit, because there's more opportunity to make money in that.
Interesting.
We have too much greed in this, in our society. We want to keep America great, right? We need to be a little less greedy, think about everyone as a whole. And I hope we work it out.
I hope we do too. Joey?
Yeah, I was, because I deal with the investors all the time with, and the clubs. So what is the best use of Property Radar for investors, especially new ones? How are they going to get the biggest benefit out of Property Radar?
Yeah, so we started off in the foreclosure information business and the property information business. And what I really realized is that pretty much all of our customers use us to go find new deals. So I actually think of us more as a marketing app than a property information app. The amazing thing about public records in the real estate business is you can know every owner of every property by name, and then pull in phone numbers and email addresses. You can contact them directly. Like it's an amazing thing about our industry is that there is public records is this white pages of every single possible customer. And not only that, but there's 250, we have over 250 different criteria to pick the right ones for you to spend your time on talking to. So, if you're putting out bandit signs or something like that, just for everybody driving by, all those things work. Billboards, radio, TV, they all work. They don't work well. You can go find exactly the right people to go knock on their door, send them an email, send them a postcard, call them, text message them, whatever, right? And reach exactly the right people. And if you're good at doing that, you're going to beat the competition to those deals. The other piece to that is almost nobody in this business is very good at it. And, you get all these yellow letters and the rest, and it's like, you're in foreclosure, you need to sell. And they have no empathy. And Bruce, I think this is why you were such a, so great at going when you were door knocking and buying houses, is you had empathy for the people in that situation. And they saw that empathy. And if you can convey that in your marketing and the rest, which you can do better in direct marketing than a billboard ad, so that's how people are using us. They're using it for marketing. And the guys that are doing really well do it with empathy, do it consistently, do it across multiple channels. They're doing direct mail and, email and online ads, and they're doing well, and they're taking business from others, and our customers are doing great.
Essentially finding a way to make it a win for the seller as well as you as the real estate investor.
Yeah, I mean, it's Bruce, you've sat across the table for more people than I have. I've bought most of my properties at trustee sale, but I think half the time it's just listening. It's just listening and really understanding what their core issue is and finding the right solution for that issue.
Yeah, and I think well, I had that experience. It's funny. I just bought a signed book by Og Mandino, The Greatest Miracle in the World. You're familiar with that story, right?
Yeah.
Yeah. So I wanted to buy a signed book because I'm going to give it to somebody that I like. But that was an aha moment for me when I was dealing with a guy that I could tell was hurting, and he was going to sell me his property. And I decided to put that aside and do something that I thought might help him. And then, later in the conversation, the next morning, he tells me I was going to sell you my house and kill myself. I never forgot that. So when I look across the table, I look at the person and not just their equity. And it wasn't a technique. It was who I decided to be. Remember, you and I talked about sometime the distasteful way the seminar business can be conducted.
Yeah.
Or it can be conducted in a much different way. Well, that's the house buying business. You can be ruthless, or you can sit across from somebody and in your mind say, if this is going to benefit both people, let's do it. But in the meantime, when I quit working for the guy that I didn't like working for, I worked there for 3 months, and he called me out of the blue about 6 months after that. And he said, I'm going to start up again. I said, you want me to work with? He says, yeah, you're the only guy I can trust. And I said, well, trouble is we do business so differently. He said, well, how do you do it? And I said, I actually go over all the options with the person, even if they don't include me buying it. He goes, well, you can't buy houses that way. I said, well, oddly enough, I'm buying my share, and I enjoy every conversation because I don't have something up my sleeve. I enjoy when the right. I enjoy when the phone rings, and I think they pick that up. It's like, oh, you know, I've even had people fight me on that. I remember a house I bought in Corona. The guy says, he said it was worth 150 grand, or he owed whatever it was, 80 grand. I thought, of course, it's not worth 150. So I go there. Sure enough, it was. And I'm trying to talk this guy out of it. Why don't you rent it? Why don't you do this? He finally said to me, you run an ad that you buy properties, and I'm wanting to sell you the property and give it to you today, and you won't take it. I said, are you telling me you're going to deed this property to somebody today? He said, yes. I said, okay, I'll do the deal, but I want you to explain to me why you want to do that. He says, I have never owed any debt in my life. I have $10,000 a month coming from a New York apartment, and I have a mortgage that I don't want, even though it'll rent for positive cash flow. That's right. I said, okay. But at least I got to the bottom of it, you know?
Yeah. Yeah.
So it's funny, but I think because you're honest and open, I love when somebody says this to me, and I knew I'd be buying the house. He says, you know, I've not told anybody else this, and then whatever's next is the most key thing.
Yes.
And then you
Yes.
go, okay, now
And
I can tell.
You don't get that key thing unless you build trust and empathy and understanding and the rest. They never share it with you.
Right. And you have to be the genuine article. So it's not
You can't take advantage of that moment. If you take advantage of that moment, I just don't think you can live with yourself, or you shouldn't live with yourself.
No, that's why I had to leave the company that I worked for. He was treating people terribly. And I hated to be the messenger, man. It's just like, nah, I'm out of here.
Totally. 100%. Yeah. So yeah, targeted direct marketing works. It continues to work. You know, we work with one company that sends 450,000 pieces of direct mail a month. I mean, it's
a month.
A month.
Wow.
So, like, you know, they buy a lot of houses.
Wow.
So, yeah. I mean, that's $2.25 million monthly spend just on direct mail, and that's only one marketing tool. There are folks out there still crushing it right now. Like, you know,
I had a really cool experience. I'll share this with you. Joey, the group I spoke to last year that does lots of deals, what are they called?
And the
Collective Genius.
yes, the Collective Genius.
You know them?
Yeah.
Okay. Well, I'll tell you the story because it meant a lot to me to watch them do this. So I'm the keynote speaker. They have a 3-day event. So I get there a few hours early just so I could observe them, you know. And there was a guy that gets up there, and he just got involved in helping kids that were being trafficked. And
Wow.
So he's the guy that owns Collective Genius gets up there with him. He said, let's raise some money for him. And so by show of hands, each finger was $1,000. In about 8 minutes, they raised 340 grand for the guy. And I just I was dumbfounded. I sat there, and it changed my whole opening of the presentation. I said, you know, when I got up, I said, I realized what this meeting is about. You guys aren't about creating real estate geniuses. You guys are creating heroes for your family. That's what you're teaching each other to be. And it was an emotional thing for me to see that type of training, if you will. In other words, that's who we are. You're going to be part of our group. That's what we do. it was one of the most
Yeah.
awesome moments for me ever. All right, Sean. Well, I guess we will see you later in the year then, right?
Absolutely. Yeah. And
Okay.
thanks for having me today. Appreciate it.
Okay. All right, Sean. Thanks so much.
Bruce. Bye, Joey.
Thanks,
Take
Sean.
care.
Bye.
Bye-bye.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.